Housing affordability is sitting at the lowest level in nearly a decade, as home buyers again retreat to the sidelines as higher interest rates crimp affordability. And on top of that, you have Fed Chair Jerome Powell cautioning that interest rates are likely to head higher than the central bank policymakers had initially anticipated. In fact, in just a few minutes last week, Powell's comments changed everything on the market's view of interest rates. As he said, if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. And with that, we saw the probability of the Fed hiking the Fed funds rate jump from 0.25% to nearly 0.5% in just a matter of a few hours. So after Fed Powell was speaking, the markets were expecting a 0.5 point increase in March and the peak to hit 5.75% before the Fed is finished. And the primary reason that the Fed has changed their stance here in the last couple of weeks is because of the January inflation data, on top of signs showing that the labor market is still remarkably strong. Now, many of you guys are watching this and saying that the Fed is trying to crash the housing market. If the Fed wanted to crash the housing market, they could do it very, very easily. But instead, what the Fed is actually trying to do is control inflation while keeping the job market strong. In fact, I pulled this clip directly off their website where it says, what is the Fed's goal? And more or less it says here that the Fed's goal is to conduct monetary policy as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So in summary, the Fed wants to get inflation back down to the 2% target while keeping the job market stable. And for the better part of last week, it looked like the job market was remaining stable as private payrolls in February increased by 242,000 versus the estimate of 205,000. Now, this report came out from ADP about the same time that the Fed was speaking and 2 days before the government's non-farm payroll count, which was ultimately expected to show a gain of 225,000 jobs created. But instead, we saw U.S. employers added 311,000 jobs in February. And by the initial look at the numbers, it looked like the ADP numbers were way off, and many of us out there were expecting the market to get hammered until you look into the details, which showed that the unemployment rate rose from 3.4% to 3.6%, showing that the job market is starting to cool from the hot start of the year. In addition, there was some good news on the inflation side, as the average hourly earnings increased only 4.6% from a year ago. So while it is still increasing, it's below the estimate that was expected of 4.8%. So yes, the job market is growing. Yes, wages are still growing, but by the looks of it, it looks like the data is starting to soften a little bit. Now, you might be watching this going, how does the US add more jobs than what is expected? And at the same time, you see the unemployment number go up. How is that even possible? It's because there's actually two different surveys going out, one measuring unemployment and the other one measuring job creation, if you will. And by the looks of it, it doesn't look like either of them are very, very accurate. So if you're out there counting on this information to make decisions, be careful, because as you can tell by looking at the numbers, they don't always jive. In fact, you often see revisions month over month when the new numbers come out. They often revise the previous month's numbers because they were off. But either way, with the unemployment number rising and the better than expected news on the hourly earnings, we actually saw the probability of the Fed hiking the Fed funds rate by 0.5% in March drop from that 71% number to just under 50%. In fact, yesterday, it was sitting at 68%. So it dropped nearly 18% today after the jobs numbers were reported. So at the moment, you have half of the people out there betting on a 0.25% rise in March, and you have the other 50% betting on a 50 basis point hike in March. So who's going to end up being right? Now, before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, any value in the time it takes me to create these videos, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people like you who like this type of content, and helps me accomplish my goal of educating more buyers and sellers in this crazy housing market. And lastly, if you're not subscribed, please consider subscribing to the channel to stay updated on everything anything real estate related. I think we'll likely see a 1/4 basis point hike in March, just because that is more or less what the Fed has been preparing the market for, in my opinion. But a lot of it has to do with the CPI numbers that are reported tomorrow. As you can see from this chart we posted a couple of months back, the February data that's reported in March should actually show high replacements on both core and shelter, which should allow a larger than expected drop in inflation. And because the Fed meets next week, after the data is released tomorrow, they're likely to be able to factor this into their decision making. Now, for whatever reason, let's say that we're wrong and we don't get the inflation data that we're expecting and it actually comes in higher. Then with that, I believe there's a probability that the Fed could actually hike 50 basis points in March. Now, that's not what I believe is going to happen, but it could be the case if the inflation comes in higher than what was previously expected. Now, with all of this talk about the Fed talking about their inflation fight not being over, hiking rates higher, staying there for longer, it's actually throwing warning signs out there to the economy, as the recession indicator of the 2-year versus the 10-year bond just flashed its loudest warning sign ever, with the inversion of the two hitting a record high of 103.5 basis points. This is the deepest bond yield inversion since Volcker, suggesting that a hard landing is likely coming. And that's exactly why billionaire Ken Griffin said the setup for a U.S. recession is unfolding, with the Federal Reserve needing to raise rates further after Americans were stung with traumatic levels of inflation. He goes on to say the Fed is limited in how much it can fight inflation with just interest rate increases. He says it's like having surgery with a dull knife. So as we've discussed over the last couple of months, the Fed definitely has its work cut out for them. In fact, I believe they're stuck between a rock and a hard place. If they raise interest rates too high, then the likelihood of a hard landing is very, very high. If they stop here, I believe the likelihood of a recession is still really, really high. But if they paused, they started cutting rates, and inflation remained high and ultimately never got back to the Fed's target, then you have even bigger problems coming down the road. So the Fed is doing about as much as it can do. So how does that actually affect the housing market over the next couple of months? Well, as I've mentioned before, if interest rates continue to move higher than they're currently at the moment, we're sitting somewhere between 6.5% and 7%. If we see interest rates go above 7% and stay there for an extended period of time, you're likely to see home prices pull back even further. Now, if interest rates come lower, we've already seen that adds buyer demand to the market. In fact, we saw that in January. When interest rates came down, we saw more buyer demand in the market picked up, and we actually saw some stability in a lot of markets out there. But at the end of the day, it comes down to not only interest rates, but inventory. At the time we're filming this video, we're sitting somewhere around 418,000 homes on the market, which in the big scheme of things is really nothing. In fact, we need about 6.5 million more homes on the market to balance housing out as a whole, and that's not likely to happen anytime soon. So just remember, if you're buying a house, make sure it's the right time in your life, you're buying for the right reasons, and you have a longer term time horizon. But if you want to know what else is going on in the housing market, do me a favor and check out this video here.